In this morning's U.S. Bank Economic 360, recently the European Central Bank announced a 60 billion euro purchase of bonds and asset-backed securities. For comparison's sake, the purchase is similar to the quantitative easing the Fed has pursued over the past several years. Joining us to talk about what this means for U.S. investors is Mindy McLaughlin, U.S. Bank's Senior Vice President and Senior Portfolio Manager. She's with Kelly Leon in the studio. Ladies.
Thanks, Peg. Hi, Mindy. Thanks for being here.
Good morning.
This is a heavy topic.
Yes, it is.
Quantitative easing, what is it and why are they doing this in Europe?
Sure. Yeah, it's back. Quantitative easing, if you remember, our central bank did this, the Fed did this here. Basically what it is going out and buying bonds of European countries in an effort to raise the prices of those bonds, which pushes the interest rates down. And really the reason they're doing that is they're trying to get consumers and companies to spend more so they can kind of get out of the slump that they've been in. And I mean, really, Europe's been teetering on a recession here for quite a while. And they've been struggling to get growth, and they've tried the austerity thing, and I think they've realized that's not really working. So this is a pretty big program. They've committed to spend about 1.1 trillion euros over the next 18 months, and they've kind of left the door wide open there if they need to continue this for a longer period of time.
Well, you answered this a bit, but you know, what specifically in Europe happened to cause this?
Sure. The unemployment rate in Europe overall is running at around 12%, and that's just kind of the headline rate. I mean, if you look at some of the southern European countries and some of the younger population, it's even higher than that. And that's twice what the rate is here at home. And so they have really never fully recovered, I don't think, since the Great Recession or the financial crisis of 08 or 09. And they've tried lowering rates and doing some different things to spur the economy, the austerity measures, and that really didn't work. And what they're fearful of is consumers have seen prices fall, and so they're kind of waiting. They don't buy because they think, well, prices will continue to fall. So this is kind of an attempt by the European Central Bank to say, hey, we're serious about doing something here, and so we're going to go in and try to make rates lower so that companies will invest, and specifically they want to devalue the euro to make the exports a lot cheaper, and so that will increase the competitiveness of the European economies.
So is this strategy working?
I would say, I mean, it's new. It's just been released here in this year, and so far I think what we're seeing is that it has been well received, and the European stock markets have risen some and certainly stabilized. The euro has fallen, and that will make their exports cheaper, so they will become more competitive.
And what about the impact here in the U.S.?
That is going to be the interesting thing, because obviously here at home, our economy's been doing pretty well, and we've talked about that and so forth. And specifically with the bond market, what we're seeing is Treasury rates by historical standards. U.S. Treasury rates are pretty low. But when you look at the interest rates around the globe, certainly of the developed countries, we have the highest rates. So what's happening is a lot of foreign investors are coming in and purchasing our debt, and so that keeps our rates low. And that's something that the Fed, I think, here would like to see higher rates, but because of these other forces, that's not really happening. And then on the stock side of things, the equity markets, I think it's going to be really interesting to see the impact of this, because what's happening with the dollar strengthening, it makes our goods and services that we sell abroad a lot more expensive. And just this week you've seen, like Procter & Gamble, for example, had corporate earnings, and they cited the foreign currency thing as a big area that presented a problem for them. How do you manipulate? They have business all across the globe and so forth, and so not only are our goods more expensive, but also they have to deal with the foreign exchange component. So it's going to be interesting to see how that impacts us. Earnings, I think, are coming down a little bit, so that's something we're going to really have to watch, and we'll probably talk about again.
Yeah, well, thanks for taking a difficult topic and making it a little bit easier for us to understand.
I hope I did. Okay.
You always do.
Thanks.